Welcome back to the Higher Standard, friends. I apologize for taking Friday off. Obligatory can pop. Had to speak to some kids on Friday about the banking space. I was invited to do an event, and I thought, why not? I had a lot of fun doing it, and I owe a lot of kids some responses back to some messages. We talked a lot about AI, talked a lot about the banking environment and how much money you can make, which is kind of cool because I don't think most people go in there and talk to the kids about how much money they actually make. And I did that, which, well, in part anyway, more of a case history of what I used to make. That being said, welcome back to the Higher Standard Live. I'm your host, Chris. This is the only show that gives you everything that CNBC gives you in approximately 1 hour. We're going to look at the social narrative, behavioral economics, as well as our proprietary models, the status of the market, the synthetic volatility index. We're going to look at the sectors. We're going to do a little bit of market forecast, and we're going to use our little tool that leverages AI to skim the markets and tell us what the rhetoric is. Spoiler alert, it's all about oil right now. That's still the main part of the controversy, geopolitical unrest, and what that means to the economy. I do believe that this is just as much as an economic war as it is one fought by missiles and bombs. That being said, this show is brought to you by the loving team over at Fridays. Go to joinfridays.com, enter code HIGHER. You'll get $100 off your first order, and we'll get some love and appreciation. If you don't know what they do, everything from GLP-1s to longevity drugs. Think NAD+, for example. I'm a big fan of them. Ceramorelin, tesamorelin, stuff like that. All the peptides you've been hearing about. But you want to go through a doctor. You want to go through a team. They have very easy and convenient ways to do that. You can either message them via text, via email, and even a phone call if you would prefer the old school interaction with the video chat. Okay, with no further ado, what up, Vic? If you haven't watched the show before, you can comment in real time in the live stream. I do bring that up towards the middle end of the show. I like to let the comments accumulate a little bit and let you guys derive some feedback. I know the weekend has been less sexy than other weekends. There hasn't been a whole lot of news to really push the market. Everything has been Iran controversy, geopolitical unrest, and the oil dialogue. There's been really not a lot else of anything else, which is actually a good thing for the market. With no further ado, let's get into the market status. This is us today. We're back in a narrow tech-led rally. You can't call this level of volatility. We have the Dow, S&P, NASDAQ, Russell, and the QQQ all popping up. What up, Yoshi? How you doing, brother? And yes, Vic, a crispy can pop, sponsored by my friend Andy Frizella over at First Form. We drink nothing but Form Energy when we can get our hands on it, although it'll be on the West Coast a little bit harder some days. So, if the market is all up, we have a tech-led rally. NVIDIA is doing their conference today. You can expect to see an overall positive day. There is a bit of disinformation we have to get out of the way right out the front, and that is the Strait of Hormuz, as much as the rhetoric is it's open and there's oil tankers going in and out, that is not necessarily proven. I don't know that rhetoric is going to be meaningful. I expect to see more volatility in oil prices as we continue to proceed. But we have other things that aren't making headline news that we need to talk about at some point throughout this show. Number one, there is a really, really bad thing happening in the housing market. You're starting to see it. All this narrative about supply, all this narrative about rates doesn't seem to be changing the fact that the environment there is struggling. Housing, as you should know, is hyper-regional. So if you don't see it in your area, it's happening in other areas across the country because the average numbers speak for themselves. We're going to talk a lot about that at some point in the show. We're going to talk a little bit about this private credit default regime and some of the things that we're really kind of experiencing now and seeing firsthand. I spent a disproportionate amount of time this weekend looking at bank public filings, their call reports. Every bank that's traded in the company, whether it's publicly traded or private, has to file a call report. That call report is publicly available to you, to me, anybody else. You can go look them up. Just type in bank CALL call report, and you can find their financials. That'll include their income statement, their balance sheet, some of their strategic initiatives. It's very similar to some of the SEC filings, although it's got a more bank-oriented accounting methodology and way of displaying the data. I prefer that. I also cross-reference that if it's a publicly traded company to publicly traded information. But a lot of the community regional banks, they only file call reports. They're not publicly traded, so that's your best source for information. I went and looked at that because that isn't the stuff that Wall Street's going to get their hands around very often. It takes somebody a little more sophisticated to get their arms around it. And I've happened to be in the business for 20 plus years. I am very much afraid of what I am seeing there in that space. I think there's some community regional banks that are taking a whole lot of credit risk in the, and we're going to use a sexier term here, non-depository financial institution space. And for those of you who are unfamiliar, the way it works with the regulators is that they, NDFI, that's the acronym, non-depository financial institution. You're going to see that a lot in the news and in the headlines once the rhetoric around the geopolitical conflict dies down, or at least finds some level of fluidity that's stable. Right now, we're not even there, so that's going to be top line headlines pretty much all the time. But this NDFI, non-depository financial institution space, is going to be top of the headlines. It is building up to be something almost worse than the great financial crisis in that there's just more volume of potential defaulting assets. That remains to be seen. Some people believe it's just hyperbole. Some people believe it's much ado about nothing. But the one thing I can tell you unequivocally is that more banks are tied into this than not. As a matter of fact, 87% of the lending to these private credit companies that you're hearing a lot of risk, a lot of these redemptions, people are going there saying, hey, we want our money out, and we're going to talk about that. That is done by banks. Large banks too. I'm talking all the GSIBs, globally systematic important banks, the Wells, the Chase, the B of A, the JP Morgans, all of them, right? I mean, Citibank, sorry. So you're going to see a lot of pressure in that space and a lot of this NDFI conversation. If you're in a bank, you're probably hearing that during your regulatory exam. It's a big deal. Can I speak on private equity? I'm hearing possible meltdowns. That's exactly what I'm talking about. Is the private equity is considered a non. So let me back up here. The private credit space includes money that is lent to private equity. Private equity is another form of non-depository financial institution, right? They don't take deposits in, so they're not a bank, they're not regulated. Private equity is part of that. So yes, you are hearing that right. Private equity does have some weakness. Matter of fact, last I checked, private equity distributions are at a 16-year low, meaning the money they're paying out of exiting some of their funds is slowing down quite a great deal. As a matter of fact, the lowest in 16 years. So I am not a private equity fan for a number of different reasons. But I think, number one, they make money when they do. But my reasons for not liking them is, well, I kind of got screwed over by them, point blank. And I kind of think that the way they handle business is unethical and immoral. I'm sure a lot of people will take offense to that and say it's just business. Good for you. If you can stomach that level of treatment, fine, good for you. But if your entire job is to roll up companies, make them more profitable for the shareholders, and you can justify it with a shareholder return, good for you. But there are humans in this mix who are more often than not, mistreated and taken advantage of, and I hate that. But we're going to get into the financials. They are struggling. That is real, and I think that is something to be worried about. The real question is will the institutional money behind them be able to keep them afloat? And some of them that are Saudi-backed, for example, or large fund-backed behind even them, yeah, they're going to survive. So they are vampires. 100% accurate, my friend, and you are not wrong in the chat. Let's get back to the market, the market review real quick before we get into anything else. Let's talk about the status of the market here. So tech-led rally, narrow-led rally. NVIDIA has their, I think it's GTC conference today. So you're going to see a lot of headlines that relates to NVIDIA and a lot of tech-led headlines in the news in general. That's going to push this a little ahead a little bit. Let's go into liquidity here. The markets, the liquidity pulse index, fed straight from the Federal Reserve Bank of St. Louis, is tense, still at 57. But we're seeing slight improvement. We've seen a Fed balance sheet that has a flood of liquidity. Bank reserves are flooding. The Treasury account is supportive. Net liquidity level is still in a draining position, however. So you are seeing a tense Fed liquidity position. I do not expect this to change. We do have a Fed meeting today, on the 18th. So we will be covering that on the next Higher Standard Live. We're going to listen to it. It's a little bit longer. If you haven't listened to one of those before, I always highly suggest listening to that, not necessarily because of the lead up to the actual conversation. I call that kind of like the warm up. We lead up to the the Federal Reserve's press conference, and as we get into the press conference, the real meat and potatoes is always in the Q&A session afterward. So we do about 30 minutes before the announcement. We wait and listen for the press conference, get into the press conference, and then we dive into what we're hearing in real time. We'll do a recap and call it a wrap. That show typically is around 2 hours as opposed to this, but it's the closest thing that we get to, an all-star halftime show or something like that. It's good, it's fun, and there's always some quippy stuff. And I expect this one to be sexier than most. There's going to be a lot of response questions to the war, geopolitical conflict. How is the FOMC going to handle that? What's their perspective on it? I'll tell you right now, they generally hold. They're data dependent. They're not going to do much. You're not going to see a rate cut. You've seen that by the Chicago Mercantile Exchange, Fed Now, Fed Watch tool. That's showing a almost 100% probability of no rate cut. So the real value is going to be the end of that. Vic, are there any economic sectors that are vulnerable given the recent supply shocks in the economy? Yeah, there's a lot of economic sectors that are vulnerable. We'll talk about that in the sector space coming up here whenever we get into that. Let's get into the mortgage affordability. Mortgage affordability remains stretched. This model has been updated as well as the synthetic volatility index and the liquidity to be more accurate in my mind of what the model should be reflecting during times like this. Mortgage payment burden continues to be strained. Mortgage rate pressure continues to be strained. We've seen mortgage rates creep back up as the 10-year has moved up. Let's look at some of these things, actually. I haven't done that a lot today. So what you know is that you've seen the 10-year creep up, and that pushed mortgage rates up, which is going to put rate locks and the overall mortgage flow down until such time as that settles. Today, we are seeing the 10-year come down a little bit, and I'm going to go over to CNBC, which is where I always recommend you guys start if you're going to look and you're not on our show. All good. This is what it looks like. Go to CNBC, click on bonds at the top. Top left one is always a 10-year, and there you go. 10-year is down to 4.23 today, down about 5 basis points-ish, 55 basis points. This is a meaningful change in the 10-year. This is going to bring 30-year mortgage rates back down a little bit. It might drive demand up a tiny, tiny bit, but I think the volatility that we're experiencing is the bigger problem right now. If you go up here to this search box, you type in VIX, VIX, you will get the opportunity to look at that particular gauge, the fear gauge, as I like to call it. Where is it at here? Oh, there's all the, It's funny, whenever I do this on the show, let's try iVIX. There we go. No, come on, where are you, VIX? Where are you, brother? There we go. CBOE volatility index, 2378, still elevated. There you go. Anything above 20 in my mind continues to be elevated cautions, elevated fears, and instability. You should keep an eye on this. As long as this remains high, that 10-year is not in and of itself going to drive enough mortgage volume to be meaningful unless there's a cataclysmic decline, which I don't expect that. As you start to see more confidence long-term and more buying long-term and less confidence near-term, you're going to see a lot more volatility in the 10-year. Volatility is, in my mind, at least here to stay. Of course, because I know that Saeed's somewhere out there watching, I got to do the one thing I got to do every single show. Go right over here, type on the crypto tab, go to Bitcoin, and Bitcoin has begun to rally back from its low of the mid 60s-ish. We're at $74,226 a coin, which is above, last I checked, the mining cost. So this is back in what I think Michael Saylor would call the Optimus Prime era, if you will, or the hero markets where you're still the mining of a coin pays for itself with the coin's value on a liquidation event if you want that. I have different opinions on this, but people always like to point out to the economic obsolescence and the hash triggers that are there. Who cares? This is this week's event of macro and Fed events. This is our calendar here. The only one that's really meaningful this week is going to be the FOMC rate decision and the press conference there. Okay, that rate decision and press conference on the 18th on Wednesday is going to be the highlight of the week. It's going to drive a lot. Of course, tomorrow we're going to get some retail sales data. The same day as the FOMC conference, we're getting the 30-year mortgage rate data, which I can tell you is going to show an increase based on the stuff that we saw last week, even though we're seeing it down today. Everything else for the rest of the week is slightly You got some initial jobless claims. I don't really trust that report anyway. You know my feelings on it, or that it's not something to be relied on. So that being said, grain of salt. I think the real meat and potatoes, Wednesday, you want to tune in for that show. We're going to spend some time on it. This is the sector report. And Vic, to answer your questions, we're going to talk a lot about how this works. So the home builders are up. This is the 10-year dropping. The market sentiment being positive again. I think that's what's really driving this. But you've got trouble in paradise here with Lennar. This is indicative. D.R. Horton, Lennar, Pulte Group, Toll Brothers, and NVR are indicative of rate sensitivity in the market. Rates go down, this does well. Rates go up, they do badly. There's also some tertiary facts like credit standards, wartime volatility, stuff like that, which can and does impact this. But for the most part, it's always rate driving this particular type of demand. So we have something in the show notes and the links today that if you want to take a look at, will actually show you some of my concerns around this. I'm going to pull up one of the show notes here, and we're going to take a look at this. So I have in our notes here from John Brooks, February existing home sales at crisis lows. I'm going to do this in the context of talking about this in sectors this week because I think it keeps things well tightly kneaded together here. So let's go to the screenshot here. This is from John Brooks over at X. Existing home sales are already back to 2008 levels. That's happening without an actual recession. That's kind of nutty when you think about it. Okay, no spike in unemployment, no credit crisis. Okay, I'm going to put a caveat right there in the spike in unemployment language. I think the unemployment numbers are wrong. We've seen meaningful revisions down that never get the headline coverage. We lost 1 million jobs last year or so that were revised down that nobody ever talked about. The last number that came out was a miss, but it's a miss with the potential revision down again. I think it was 12 of the last 13 months have had revisions down that were meaningful. Only one of them had a slight revision up, and it was not even significant. So I don't think I think we are seeing an unemployment crisis going on here. No credit crisis. I would disagree with that as well. We're going to talk a little bit later on about private equity, about non-depository financial institutions, and this whole private credit market. I think that there is a credit crisis, and no forced selling. That's the part of this whole thing that drives me kind of like wild. That does not appear to be this like rhetoric. It seems like there's deniability, and I think I know what it is. So if you're watching the show for the first time, I've got theories on this. So I'll give it to you. I think what's happening here. Do I look a little blurry or like clear here? If I'm, yeah, I look a little blurry. Let me fix. You should be able to see me nice and clear. There we go. Let's see. Is that better? That looks better, right? I look better? Am I crazy? All right, there we go. All right, so one of the things that's a problem here is we've had this prolonged period of artificial interest rate deflation. We've had about 15, 16 years of artificial interest rate deflation, a super prosperous economy, arguably one of the most prosperous runs in economic history from just an overall business perspective. And if you were born and started your work during that time, you got a huge ego. As a matter of fact, even if you didn't, and you were operating for 20 years before that, and you got into it, you started to think, I'm really good at this shit now. I'm amazing. You never once stopped to go, you know what? I'm just a benefactor of an amazing economy. And that's really what happened to all of us. Them, you, me, everybody. It's all the same, okay? As much as we like to think that we're amazing, some of it is we just rode a very prosperous economy in an unbelievable economic time. And as a result of that, there is this disbelief in the markets that things can and will go bad. So anytime you post anything to social media, this war starts instantaneously about, oh, you're just a doomer, you're a doomer, you're a doomer. No, I am seeing bad data that is scary, okay? There is a clear problem in the housing market. We're going to talk and show you this here. There's a clear problem in the private credit markets. We're going to go over that. And everyone loves to find the exception, not the rule. And here's the way this works. I don't give a damn which side of the aisle you lie on. If you lie on the market's fine, great, good for you. If you lie on the market's bad, also good for you. I'm going to give you the data, and I'm going to let you make an informed decision. But do I think that there is a looming problem here? 100%. Do I have a bias? Not really. I just look at data a lot. So take that for a grain of salt, or take that with what you will, but that's what it is. Here's the chart. Now imagine what housing looks like when the real economy stress begins is the theory here. I think we're already seeing the real economic stress. I just think we're in denial as a society. This is February existing home sales, okay? NSA by the thousands. So long run average. So basically taking those home sales, distilling them down. This is the numbers in multiple time 1,000. You get the actual real numbers. And you can see back in 2008, 2012 here on the chart, that's where we were at. From 2023 to 2026, that is where we are at in February existing home sales. So this looks to be well below the average. Now, there's a lot of people who have a lot of excuses for this, and I get it. I'm not discounting those excuses. I'm just saying this is the data. This is not manipulated or twisted. This is just well below average. The last time we were here was from 2008 to 2011, and frankly, that was a housing recession. That's the part of this that makes me kind of weird, right? That's the part that freaks me out a little bit. Because not all recessions are housing recessions. We had the dot-com bubble burst back in 2001. You can actually see that on the chart here, which still had pretty good and strong February existing home sales. So definitely weird. Now, to be clear here, I want to explore some nuances that you need to understand. There's existing home sales and new home sales, right? New home sales are selling for less on an average cost than existing home sales, which is also strange. You get a brand new home for less because builders are selling at the high dollar amount, but netting out incentives somewhere in the neighborhood of about 25%. Lennar being the most obvious culprit of this, and we've done this on the show many, many times before. We've talked about that. So you're seeing this in a really, really weird light. Now, this is looking at just existing home sales and just the February stuff from year to year. So it's certainly interesting, but this is using NAR's data, National Association of Realtors data. So there is something here, whether you believe it or not, there's something meaningful here, and it is in fact affecting the sector. But you're also seeing mortgage rates come back down a little bit after a week of crazed volatility. So what are you seeing in the sector market? You're seeing the housing and home builder rate demand seems to be showing that the positive influence on these stocks, D.R. Horton, Lennar, Pulte Group, Toll Brothers, and NVR, is that they are actually positive today, which kind of wild, right? I'm going to pause a little bit for the comments, see who's here, who's not here. Oh, wow, we got some action over here. Phil Chong in the note. Look at, boy, how you doing, brother? I'm going to put you on the big screen. There he is. Phil Chong, what about the narrative that it's a liquidity issue, not a credit issue? If you're talking about the private credit markets, there's an argument there. I think that's something to be said, but I think liquidity issues do bleed into credit issues, right? If we have an illiquid market, what happens? You start having to figure out where you're going to put your money to work and where you're going to get money from. Well, not to be a naysayer here, what happens using the bank ecosystem as a proxy for the bigger problem, right? A run on deposits is a liquidity issue for banks. So what happens in a bank setting? The bank has defaults, right? Or the bank has some headline risk. And today, credit defaults and headline risk can both cause a run on deposits. We saw that during the contagion period of 2022. But look, for reasons that, or whatever they might be, whether that's credit or headline risk, somebody says, I want to pull my money from this bank, right? Well, banks make money off of making loans, right, with your deposits, right? So if you pull your deposits out, okay, then, and they deplete their liquidity position. As they deplete their liquidity position, they ultimately have to sell loans to give depositors back their deposits, because the only way they make money is on net interest margin. The spread, the difference between what they charge on a loan and what they give you in your deposit rate is an interest rate. So if this is 7% and this is 5%, their profits are 2%, right? Well, they only get to keep that if they deploy the deposits, right? If they don't deploy the deposits, they're just paying you 5% and they're not using that money. That means they're actually losing money by doing that. So banks are incentivized to arbitrage the deposits to make money, because that is how they make money fundamentally. These private credit funds are no different. Okay, if their liquidity gets tapped because there's redemptions in the fund, meaning that more people are going in saying, I want to get my money out of your fund, I want to redeem my position to get money out, that is not a liquidity issue in and of itself. That is what bleeds into a credit issue, as these funds have to sell down assets either prematurely, at a loss, or frankly, at a position that jeopardizes their future viability. So liquidity issues do segue to credit issues, and that is 100% accurate. I think that you are seeing that. It's just that I think some people are talking about this in the, hey, this is where it's going narrative, and some people are talking about this and this is where it's at narrative. And that's the only difference between the two that you're looking at there. Saeed Omar in the comments, I've heard about this guy. He's a sexy legend. Oh, he's my co-host. I agree. People deserve to hear the truth, and sometimes the truth sounds like doom and gloom. However, we prefer our listeners to be considered well-informed versus the fed gumdrops and lollipops. Yeah, and if you're listening to the show and you're new to it, it can be very easy to think that this is negative, my friend. And that's one of the things I'm very cautious about. That's why I think your ad here is always positive, Saeed, is that you come in with a more rosy, optimistic perspective, and I tend to be the jaded asshole. It just happens to be that I'm the only jaded asshole on the live streams. What else we got here? We got wealth gum. Oh, look at this. I don't get emojis, but I got a face red heart shaped, so I love you too. I appreciate that. All right, let's get back to Instagram real quick and comments before I go into the sectors. All right, look, everybody's taking care of it, looks like. So let's clear this off real quick, get back into the sectors. We got a lot more to cover, and believe it or not, an hour is not a lot of time to get a lot of this stuff in some days. So this is the sectors. Let's get into the next one. You know that we cover all the sectors all the time. Banks. Well, they're actually positive today. They had a pretty rough couple of weeks. JP Morgan, Bank of America, Wells, Goldman, and Citibank. I think the response by the banks to proactively respond to the private credit fears is twofold. One, they're being smart about this, right? They're trying to disintermediate their risk from the risk that the private credit groups have, even though they do have exposure to private credit groups, because that lending is 87% done by these banks. But again, that NDFI pressure that I keep bringing up, right? Dude, I'm having all sorts of weird technical glitches today. NDFI, there we go. That NDFI pressure that we were talking about, their regulators are in their offices talking to them about NDFI risk, and they're asking them to quantify it, stratify the data, tell us what the risks are, what does this look like, write down stuff, get into it. So the pressure on the banks internally from their regulators, whether that's the state chartered non-member or OCC regulated or National Association, look, they're all getting the pressure. That is the buzzword right now. You're going to see it. That, and I would say probably energy sector conversations if you're exposure to it. So credit conditions remain to be slightly positive today for the banks who took proactive decisions to write down and have started to voice concerns over this market. Jamie Dimon, of course, leading the way. Lloyd Blankfein did the same thing as well. Moving on to commercial real estate and REITs, positive here. If you've been watching the show for some time, you know that I feel strongly that REITs are going to do well, and commercial real estate that does have a data center or tech forward spin will continue to do well and have a positive kind of outlook for the future, even though we associate commercial real estate with office, which is under a lot of pain points. And the reason why is, well, it's quite simple. We go back to the first chart we looked at here, the market status. We're in a growth run, healthy bull market now. So now we've shifted mid-show from a tech-led rally to now into the growth run, healthy bull market space. The market is fighting back, literally, in the last 27 minutes that we've been doing this. That's nuts, okay? You're still in a wartime initiative. People are running with this. The Strait of Hormuz is open. Oil's getting through narrative. I don't think that is the case. I think it's overblown hype and disinformation, frankly. But you're starting to see a market rally now, a full market rally, which is a growth run, just based off of the headlines. And again, this goes back to the point that I made where people are in denial of the actual possibility that things could go down. We don't believe it anymore. And so much of the market is traded off of derivatives and algorithmic trading. We are in the middle of a war. Russia and Ukraine is still going on. Israel is still fighting with Palestine. The Strait of Hormuz is closed to the extent that we know, and now we're hearing that it could be open, and yet there is this rally happening. Is that nuts or what? I mean, it's just mind-blowing. Maybe I'm just crazy. Mega caps are going to do well today. Got NVIDIA reporting today, so I expect there to be positivity here. But again, you're also in a growth run, healthy bull market. So if I go to the sector, there you go. Mega cap leadership, all positive of the day. This is Apple, Microsoft, NVIDIA, Amazon, and Alphabet, Google. So yeah, all positive today. You're in this healthy growth market, and this is what the entire market is now lifting up. I think because the perception is that this war is going to start being less volatile. I don't know that that's the right move. I'm going to say that again and again and again because I'm concerned. But then I look at things that are supposed to be material impacts to this. I go to our synthetic volatility index and I look at it and say, okay, well, this is our proprietary variant of the VIX. And to give you an idea of what the VIX looks like, this is the VIX. The VIX is at 2365. It's still elevated. It's been above 23 all day. There hasn't been a meaningful drop. There's still fear. This is the fear gauge in the markets, and yet the markets are starting to rally. So there is a disconnect here, and this is a real-time data figure. And if you don't believe that one, you can go to our synthetic volatility index, which I just brought up here, 81. That's a calm market by our measurements. The market does not appear to be stressed out and freaking out. There's no panic or instability. It's not tense. As a matter of fact, there's some realized volatility in the trading at 59, and that's probably because the day started off trading very slow and is now rallied up to a healthy growth market, a bull run market, which is, I said bull run adjacent, I should probably say. So you've seen that creep up, which is the only reason why you're not in the fully 80 to 100 calm range. You're at 81 here, just narrowly tipping your toes. I mean, you're at the height of risk off perspective from our models, and you're seeing that in real time with the status of the market, which, to be honest with you, is stunning. Is absolutely stunning. Let's finish up the sectors here a little bit. Let's get into some of the consumer stuff, the staples here. I don't know that consumers are going to do as well as everybody else. And there you go. Walmart, Target, Costco, Home Depot, Dollar General. Walmart followed the Amazon path. Target followed a different path. Target's got a new CEO. I do expect them to have a much better couple of years than they had historically. Target, if you didn't follow that story, was having some difficult times because it had I would call, a lack of willingness to adjust to market changes and the new way of doing business in that space. But I'm a big believer in the consumer health sector, particularly these 5 stocks in it, because I think when consumer discretionary spending does get tight, and it will, it happens, it cycles, whether this all caused a recession or just one happens in the future, I really do believe that there's going to be some value in these companies. Let's go over the industrials here. The industrials are going to be a little mixed as well. These are real economy signals: Caterpillar, Deere, General Electric, Union Pacific, and 3M. Deere being down, 3M being down, Caterpillar up. At least companies are up nominally, so not a whole lot to talk about today. This is the one that's going to surprise you: energy, baby. After a week of rallying because oil seemed to have some pressure on it, Exxon, Chevron, Conoco, Schlumberger, EOG Resources now seem to be meh on the day, which is kind of weird when you think about it. So, and I'm going to show you a perspective which I think is also interesting here. Let's go to XOM real quick, which is Exxon. I'm going to pull up the stock chart here to show you what that looks like. There you go, Exxon Mobil. Okay, this is market open to the day. So, I mean, you're looking at a pretty interesting pop up. Let's go to the 1 month chart. Come on, chart me. There we are. All right, 1 month chart shows, again, healthy positive run, right? Go to the 1 year chart. There you go. That's a pretty good looking line there. So again, them not having a whole lot of action on the day doesn't mean that it's not been a winner. It's just that you're not going to see any near time pops. But look at that, 40% 1 year return if you invested in Exxon. Where else are you going to get those kind of returns? I mean, seriously, that's nuts. If your housing price went up this much in a year, you either would be freaking out because you own a house, or you'd be wildly pissed off because you don't. So these are meaningful numbers here. They're kind of bonkers when you think about it. And that's what geopolitical and supply risk with these energy and commodities stocks really can do for you in times like these. They don't always move like this, but we have data centers which are coming online. It's going to create more energy need than ever. You have the Venezuela situation, which now puts our crude oil refineries. You get the White House talking about restarting oil drilling off of California's coast. And now you've got the Strait of Hormuz situation. So geopolitical supply risk, the energy space, is going to continue to be an outlying winner in our mind, regardless of what happens with the geopolitical conflict. But I think there's going to continue to be some pretty heavy demand in this space. Let's finish off with the defensives, which I don't expect to have a good day here. Procter & Gamble, Coca-Cola, Johnson & Johnson, Xcel Energy, Duke, they're getting pulled up in the growth run. Again, our market status is down here in this gradient map here with the Chiron down below at all times, so you can see where we are. But they're getting caught up in the growth run. Capital preservation is still being put to work, but certainly not like outsized gains relative to the market. You saw energy doing way better than these companies. And to give you an idea of what these companies have done over this time, is you're going to see it's not as good. Let's use Coca-Cola as a great example of this. KO, baby. Still one of the strangest stock tickers in my mind. Why KO? I don't know, but what else? Here we go. This is your Coca-Cola chart. This is 1 year up 12%. So again, not as meaningful as that one-time gain in the energy that we saw at 40%, but still a great gain year over year. If I look at the 5-day chart, you're going to see there was I think there should be some volatility here. Yeah, a little bit of volatility up and down, particularly on Monday of last week. But again, a healthy, normalized, stable market. That's why people invest in these, right? They want stability over time. That's what they're looking for. They're looking for good, old, stable returns. This is 1 month. There you go. So 1 month down 0.82%. It looks big because it went from 8.882 to right here about 78. So there's really only a $4 difference. That's why these are defensive stocks. There's just not a lot of volatility. They're always going to be used. So that's the sector chart. I'm going to spend some time going into the XAI. But before I do, has anybody got any comments, thoughts, concerns? We're also going to jump into a lot of that private credit stuff here coming up. I want to give you an idea of what that's going to look like really quickly. So let me get over here to my notes. I've got the $265 billion private credit meltdown we're going to talk about. I'm going to bring that over to the other chart here to share with you. And then I've got Deutsche Bank highlights private credit risk and portfolio grows. So we're going to talk about that as well. I got both of those queued up now so we can talk about it at the end of this. So if that's more your bag, I got a lot coming your way. If you are on any of the horizontal platforms, I see you. I'm checking your comments now. Saeed, There he is. Okay, an unknown clap. I'll take it. I'll take the unknown clap when I can get it. All right, so this right here, the chart that you're looking at, is our XAI trending AI analysis. This goes over X, Instagram, all the popular feeds, brings everything in. It's going to give you the summary of what it's finding in the top post. It's going to give you an AI breakdown. It's also going to tell you the mention spike, the volatility, the risk, is it elevated, the sector impact, and all the sexy stuff. And this is the sign of controversy score. This one is highly controversial, but it does seem to have consensus. The Iran military campaign escalation. Trump announces extensive military strikes against Iran, claiming destruction of 7,000 plus targets, 95% reduction in drones, attack drones, and decimation of Iran's military capabilities, including 9 mine-laying ships, which was the rhetoric going into the weekend that they were going to close the Strait of Hormuz with mines. So that's what it is. AI's thoughts on this? Not mine, just AI. While military success claims suggest potential oil price relief, geopolitical uncertainty typically maintains risk premiums longer than fundamentals suggest. So people are hesitant to feel otherwise. Well, now I would say to AI is it, okay, but the market seems to think that it's moving already. So this is one of those cases where AI might be doing the logical thing, where the markets are not always logical, dude. It's just that's the way it is. Let's look at the number 2 trending topic. Again, related, global fuel prices in crisis. Fuel of prices of oil in Singapore hit record $140 a barrel, up from 146% year to date, surpassing 2008 and 2022 crisis levels as Iran conflict disrupts global shipping routes. And the reason why is 80% of the oil for Asia, 80% of the oil that goes through the Strait of Hormuz is going to Asia. And Singapore, being an Asian country, is going to be impacted more than anybody else because of that. And some of these refineries are still closed down, by the way. Record fuel prices create asymmetric risk. Energy stocks may outperform despite broader market weakness from inflation concerns. And we've seen that in the energy sector stocks that I brought up just a few moments ago, where you're seeing them perform well, despite the fact that there seems to be an oil shortage looming, internationally at least, anyway. Everybody's tapping into the strategic reserve. So, yeah, crazy. All right, so this is Strait of Hormuz security crisis, the number 3 trending topic. You notice a trend here? International disagreement over securing critical shipping routes as Germany refuses participation in Trump's initiative while oil transit remains severely disrupted. AI's insight: Allied non-participation signals prolonged disruption risk, considered shipping logistical companies with alternative route capabilities. So anybody who can go to a different route or through a different route, that's going to be something to consider or focus on during this time. So that's going to be an interesting perspective. Okay, it took us 4 trending topics, believe it or not, 4, to get to where the U.S. budget deficit explanation is a non-geopolitical conflict headline. That's wild. Clearly, it's dominating the headlines. U.S. budget deficit, Treasury deficit jumped around 225% month over month, $308 billion in February, with fiscal year totaling reaching $1 trillion, third worst start in U.S. history. Yikes. Massive deficit growth during wartime spending could accelerate bond vigilante concerns. Wow. Monitor long-term Treasury yields for inflection points. Yeah, okay, there you go. Treasuries could be acting strange, and I think we're going to see them act strange. Okay, so we're at 38 minutes. I rushed through it. I want to spend some meat and potato time, some real valuable time on this private credit debacle. It is, for no better way of putting it, a clusterfuck, okay? So I'm going to give you some context based on some of the stuff that I've posted so you know where I'm starting before I get into the next 2 articles here. So what I'm going to do is, if you don't follow my TikTok, Threads, or LinkedIn, these are there, and you can go back and see them in broader detail that we're going to discuss today. But one of the questions I posed just the other night, and I'm going to go to the social view here, was inside baseball and private credit. Private credit funds lender of choice is major banks, okay? Major banks hold 87% of the loans made to private credit funds themselves. So the structure often looks like this. It goes from banks to private credit funds, then to the companies who actually need them, where the investments are happening, right? If banks can't or won't make the loans directly, they lend to someone who will, i.e. the private credit funds. Now regulators are rushing to scrutinize non-depository financial institutions, NDFIs, exposure as defaults rise and redemption rate pressure builds. So I'm going to show you 3 charts here in successive on the bigger screen. Number 1, I'm going to show you that even the big banks are playing this game. JP Morgan Chase, B of A, Wells Fargo, Citi, and PNC. Right there. 1, 2, 3, 4, and 5. Okay? Those are your largest globally systematic important banks. And you can go, okay, well, there's US Bank, Goldman Sachs, Truist, State Street, and Morgan Stanley. Those are all the big players out there. They're all making loans in this space. But the scary thing is not them. These guys are okay. They're going to be fine. They're going to be able to hold the reserves. They're going to be able to, slow down the money. They got a ton of huge trillion-dollar balance sheets. They're fine. They're fine. It's the community regional, particularly the super regional banks that have exposure here. You'd be surprised some of the largest lenders in this space as banks are actually not the biggest banks. I mean, Wells Fargo and B of A are pretty big, but you know what I'm saying. Like the reason why is this. Okay, let's say you're going to make a $500,000 loan, right? And you're going to make it to a mom and pop business. You get deposits from them, it's great. But you're not growing your balance sheet. Now, if you've got liquidity, because you got a lot of deposits, and you want to deploy it fast, you put it into a non-depository financial institution loan that pays you more interest. So for example, on a commercial real estate loan, and I'm using hypotheticals here, you could earn about 5% on average over the last, call it two years, on a weighted average coupon. But if you went into these non-depository financial institution loans, you could probably make about 7% on average for those loans, right? Now, if you're paying somebody 3% for their deposits, instead of having a NIM, which you know how banks make money now, of 2%, you get a net interest margin of 4%. You've doubled your profits. Okay? That's why these banks are in this space. They put more money here. Now, these are typically considered to be riskier assets, and the way you risk rate them and carry reserves for them is important. You carry reserves on them based on the historical data. There's a rule that came out, and this is going to be a little complex, but bear with me, right? Where there's something known as CECL in the banking space. Current Expected Credit Loss Model. This was meant to be a proactive, not reactive solution to how banks reserve funds for losses. It's a future forecast of loan losses at origination or acquisition of the loans moving forward, right? Anytime you make a loan, you got to set aside a reserve, but those reserves are based on the historical performance of the sector and your bank in particular. So you can pull down data from companies like Moody's and PNC and and S&L and all these companies, and you use those to support your losses. Well, if losses in the sector have never been big, that means the reserves you set aside are probably not enough if they go above the average number, okay? So, grain of salt. On to chart number 2. Chart number 2 goes to show you where the money is coming from in aggregate. I just showed you the bank names. Well, here you go. You got US GSIB banks, globally systematic important banks, right? That's number, so I should probably put you on the screen here. There you go. That's number 38. Those are your GSIBs. Number 28 here for a foreign GSIB, so foreign globally systematic important banks. And then, of course, you've got the commercial banks, number right there, 21. And everybody else in between, asset managers, insurance, and broker-dealers, are only, believe it or not, 13% of the pie of where these non-depository financial institutions get their money from. That is crazy how concentrated it is. But I just explained why. Banks can make double if they lend to these companies and get higher interest returns because nobody else in their right mind is going to lend to them besides these private equity companies, which get loans and leverage their money. So let me explain, okay? One of the challenges you have if you're in private equity is you're going to get investor money, right? And that investor money could go into an investment, right? Except here's the problem. That investment with your investor money isn't pure because you're going to take, for example, 30% of investor money and 70% of bank debt, and you're going to get into a bigger investment. And that's really, really paraphrasing here. That's how the capital stack works for these investments. There's always some type of financing which went along with the original investment money to get scales of economy, to leverage it more, right? Because if that return is 5, 6x, you can pay down the debt, you made more money, you bought a bigger company, and so on and so forth. It's never pure investment money. It's always got a debt element there. That's just the way this game works. That's how private equity works. And when you think about it in the context, you got investor money, you got debt, these add these together into this vehicle over here. If the investors want their money back, i.e. redemptions, say, hey, yo, I'm a limited partner in this. I don't like this investment anymore. This is bullshit, right? I don't want to be involved in the BS anymore over here. I don't want this. This is risky. I want my redemption. I've got a period of time where I can get my money out and pull out of the investment. I want it out. Fine. You still got to pay the debt back, brosif. So now the cash flow coming back from this, going back this way, I hope you got liquidity on your balance sheet, which was Phil's comment earlier, right? This only works for so long, which is why you're hearing the rhetoric of these companies stopping redemption, saying, nope, you can't get any more money out right now. We can't do that because they don't want to have to sell assets to pay people back. Now, the problem is they can do that contractually in most of these situations. However, if the defaults start happening on the credit side of things, or those companies start going under at an increasing cadence, you have got a problem, because now you don't have the money to pay people back when the redemption period opens up again, and they have a contractual right to get that money back. And of course, here is a survey that shows that. This is default rates, private credit versus bank loans. UBS warns of private credit defaults could reach 15%, 3 times the 2008 credit default peak. Now, to give you an idea of context here, okay, the default rate in around 2008 was actually not too far from this for single-family homes. So if you're going to get 3x that in the private credit markets, and this is, again, a forecast, this is not real yet, you're talking about a cataclysmic wave of economic strain unlike anything we've ever seen before. And it won't be as impactful to the consumer directly, because these are private companies that are borrowing, and then there's private equity firms, which deserve it, and there's the banks behind them, which have to leverage their position to figure out a way to work out these assets at the end of the day. So not fun. And let me be clear about something that I'm sure most people don't understand. Okay, so the way this works is private equity gets in, they buy a company, they try to optimize it, package it together, sell it off. A lot of these companies fail. We've all known a company or two that have been purchased by private equity that has ultimately failed. And as a result of that, it's pretty clear, you can tell just from being a human in the world, that private credit in private equity is not really good at managing through troubled assets, right? They don't manage through them because that takes time, effort, and energy they don't want to put in. They want to package them together, sell them off as a better vehicle. They want to optimize and be efficient. Well, if they don't manage bad assets well, and you get more and more bad assets, who's going to fix these assets to get the equity out of them? No one. And therein lies the ticking time bomb that the market is continuing to focus on. I'll pause now. I've been talking at you for a pretty long period of time. Comments, we got Saeed out here making some stuff. Ooh, wow, look at all the comments, brother. I turned my head for 1 minute and you're over here making a ton of comments. All right, let's go one by one, huh? I mean, you are the co-host, brother. Fun fact, Coca-Cola chose KO in 1923, replacing the initial CCO used in 1919. What? Strange. Maybe they wanted a knockout drink. Huh? You see what I did there? No? All right, let's see what else we got here. Display. The ticker symbol Coke is for the bottling company, while KO is for the symbol for the parent company. Oh, did not know that. Okay. See? You are smart. Sides of the comment here, Saudi Arabia and UAE are the primary countries capable of bypassing the Strait of Hormuz using existing pipeline to the Red Sea and Gulf of Oman. Yeah, the other side of things, but it's a logistical nightmare. It's not as convenient from what I understand. Not my subject matter expertise, though, because believe it or not, I'm not an oil magistrate. Let's see here. Under the old incurred loss model, banks waited for a loss event to occur like the default. Yes, that's right. Before booking a reserve. So yes, they would wait for like signs of stress in the books, and then they would put credit reserves. That was a reactive model versus a proactive model. CECL requires proactive provisioning when a loan is made. That's right. Now factor in the impact this would have on earnings. That requirement set aside a large reserve immediate. So yes, when you do that and you set aside a reserve, you're taking earnings that you could pay as distributions to your shareholders or dividends, or you're just taking as profit for your bonus if you're an executive or something like that. You actually have to take money out of those earnings, right, and put that aside as possible reserves and build up that reserve over time if you don't have that liquidity on hand at all times. So you're going to have some liquidity on hand. You already have a reserve for other assets anyway, but you're going to continue to add to it. And depending on how big and how many of these are, you could run out of liquidity internally to do that, because you could eat up your reserve. That's how companies get net operating losses in a quarter. That's how you can have these losses carry forward. So there's a lot of accounting vernacular in there, but suffice it to say things are looking already pretty rough, if you will. So the articles I wanted to get into here, I'm going to go ahead and get into the first one from Yahoo Finance. You'll find it also in the show notes if you want to read it at your own leisure. This is from Yahoo Finance, the $265 billion private credit meltdown, how a Wall Street's hottest investment craze turned into a panic. Well, I already told you why it was hot. They made money. Okay? It was a glorious time to make money from the early summer of 2023 to the close of January 2025. Private equity stocks staged what many rank as the single biggest surge over a tight time frame in the annals of financial services. In that 18-month span, Blackstone notched total returns 58.2% because they doubled their profits in these riskier loans. Okay, there's a theme here, right? Okay, Ares, Apollo, and Blue Owl achieved 68.1, 77.9, and 80.6% respectively, and KKR led the charge with 103.4%. Wow. Then the cyclone came starting September of last year, an historic sell-off that from their peaks sent down Apollo 41%, Blackstone 46%, Ares and KKR each 48%, while Blue Owl dropped by 2/3. The wipeout has erased over $265 billion in market cap. Blackstone and Blue Owl are now trading far below their levels of late 2021, and the sudden drop left KKR, Apollo, and Ares showing puny market trailing gains over that near half decade. Is the severity kicking in here? Are we starting to get the picture? These are big companies, big firms. They'll be fine. There's a lot of people that are not this large that are going to be a problem. Okay, so again, it is what it is. I haven't checked on Instagram in a while. You guys still out there? Who's out there? Hi, this is on your is this on your YouTube as well? I'm hoping to rewatch after the work. Yes, so big fan. Thank you for that. So Instagram penalizes us for not having the consistent viewership over time. So we take the lives off of YouTube, and you can find this YouTube in the either LinkedIn events for my personal page, or you can find it on my personal X account. If you have the link and you want to save the link on YouTube right now where it's streaming, you can always go back to that link, but the actual live will not be publicly registered. So as long as you save the link in YouTube right now, you'll be able to come back to it at any point in time. It's always there. It's just not listed on our actual YouTube page because we think it's valuable, but it penalizes us in their algorithm. So we've got to figure out some nuance there. I personally hate that. I like to leave these out there, but the algorithm is what it is, and we want to try to grow on that platform. It is the one platform, YouTube, that we've been lagging on growing for quite some time, and Said and I are kicking ourselves in the ding-ding for it. To be sure, the PE business has suffered from overpaying for its buyout picks in the period of ultra-low interest rates, a problem that is forcing them to hold their portfolio companies for extended periods. They have a plan when they start buying companies to exit them in 3 years or 5 years, right? And to exit the investment and return capital to their investors. We talked about the investor and the equity stack, right? They don't want to carry these loans for a prolonged period of time. Some of them are shorter duration loans. They certainly don't want to carry investor money. They want to return investments. But we're talking about a 16-year low of returns on investment for these vehicles as it is now. And you can kind of get the picture as to why. And this is before credit defaults. This is before meaningful things. This is just the headline risk and some slight awareness. Okay, this is not the real deal yet. Okay, this is just this is the tsunami. This is the wave pulling back a little bit, and you're going like, oh shit, there's going to be a big wave coming. That's what's happening now. We haven't even seen the big wave hit. So now panic is roiling the funds holding loans to software outfits perceived to be threatened by AI, and investors, especially newly recruited retail folk, are demanding their money back. It resembles a run on a bank, says Mart Swain, co-head of equity capital solutions at investment bank Houlihan Lokey. It's because it is a run on a bank. If these were at the bank, you would see a run on bank deposits right now. But because these are not at banks and banks lend to private equity firms, taking that risk and putting it outside their institution, those private equity firms are getting something known as a run, not a run. They're getting capital calls, right? They're getting redemptions, as you heard in the news, of higher percentages. That is effectively what that is. It's a run on the bank, but it's just where the money is being invested at, and that in this case, it's invested at the private credit fund, the private equity fund. So yeah, that is happening. That is exactly what it is. Matt Swain, whatever his name is, not wrong here. Okay, that's absolutely the accurate thing. But the problem is most people don't have the financial literacy to understand the mechanism and what this really is. If I told you, oh my God, Wells Fargo's in trouble, you should get your money out, everybody's pulling the deposits out, you would freak the fuck out. But if I tell you, hey, Wells Fargo made a big ass loan to this private equity firm, everybody's pulling their money out, you go, what is it? What do you mean? I go, well, redemptions. You go, what does that mean? I go, well, let me explain to you the redemption process. Look at investments, equity structure, and you go, I don't get it. Fuck it. Wells Fargo's fine, right? And you go, well, yeah, for now. But that's the problem. The retail investor does not understand the nuances of the risk of something like this until it impacts the names they know, okay? And I'm not trying to, I guess, make everybody sound stupid. It's just that this is a complicated structure set up by complicated people in the finance space post Great Financial Crisis with the rules of Dodd-Frank and the ability to repay on the housing side. This is also part of the reason why the country's largest mortgage lenders are non-bank lenders now, right? There's just so much compliance risk. Banks are like, let's just push it out and we'll do what we want to do that's risk-free or risk-less, if you will. So the problem is that regular folks, see the timing of that? This is from the article, Yahoo Finance article, draw on these to these funds, high yields in many cases are caffeine today has been wild, are proving far less patient than super long-term holders that are traditional pillars on private credit. Now, enough of those newcomers are seeking large redemptions. See, I don't agree with that. I think even the long-term investors are also concerned here, but whatever. Large redemptions are causing major distress in the PE's world's biggest and most profitable funds. The demands are so big that in many cases, the industry's giants are in some cases shutting the gates, further raising worries and spurring the hunger to flee. Yeah, you tell people they can't get their money out, they're concerned they can't get their money out. I mean, that's my misinterpreting that. That's pretty bad. So how did things go south so quickly, and can anything stem the bleeding? Well, the answer is no. So I'm going to give you the head. You read the article; it's sensational. But I'm going to give you some like headline stuff here. Big PE firms are gating the exits, and retail investors are trapped inside. Okay, yeah. For example, Blue Owl garnered about 40% of its over 300 billion in assets under management from individuals. Okay, if 40% of your assets came from individuals and they want their money back, you got a problem, right? The whole idea, as Morgan Stanley states on their website, was to democratize the market by giving the average people access to the same products as, say, pension funds or multi-billionaires. The appeal was obvious. Blackstone credit fund BCRED has delivered annual returns of 9.8% since inception. Okay, so right there, out the gate, if you took Vlad's Robinhood model to democratize the space, cute. But you're also assuming that individuals are going to behave like institutional investors. They don't. Did GameStop teach you nothing? I mean, come on. So, and you're expecting them to have the same financial wherewithal, an individual retail investor, as an institution? Well, institution's got a completely different financial profile, a different risk appetite, a different willingness to take risk for bigger returns. And just to be the asshole here, if Blackstone and everybody else are making 40% KKR in some cases, 100% returns, these nonsensical returns, but your fund, BCRED, is only delivering 9.8% since inception, who's getting the money, buddy? Do I got to be the guy? Who's getting the money? And am I the only person who goes, wait a minute, wait. Returns on your company stock are way higher than this that I'm investing in, so there's a delta here of money going somewhere else, and it seems pretty obvious it's going to you, okay? All right, Rosalie. So the new chair appointment conveniently chosen for another bailout? No. So I don't think that Warsh is that guy. I think Warsh is the last guy I expected to be picked, to be honest with you, Rosie. I think that Warsh is not going to be able to meaningfully change this. Keep in mind, so now there's also a problem, too, which probably should address. It comes out on tomorrow's show, but the political zeitgeist around Warsh's appointment is going to get really, really interesting. Because what happened is now you've got the House and the Senate saying they're not going to push anything forward until they get closure on some details. Lisa Cook being one of those details. So you had Jerome Powell supposed to leave in May. And now he's been cleared of any wrongdoing via this pretty landmark decision from the Supreme Court. And now you got the Lisa Cook decision. You could have emboldened Jerome Powell and Lisa Cook and everybody else to stay now, because now they feel somewhat invincible by suing them, making all these accusations. So if Warsh comes in, he's only one vote. And they really need Lisa Cook out and Jerome Powell out to get enough people with similar mindsets of voting to cut rates to make that happen. You could see a very tense and different change. Now, Myron and Warsh can make all the noise they want to, but unless the voting members that are existing, that are outnumber these new voters, are going to change meaningfully, you're just going to get more dissension in the FOMC, not much change, if that makes any sense. So I don't know that Warsh is a guy for a bailout. I don't know that you're going to need a bailout, but I certainly don't think that he's going to be able to have the impact people think. And I am still stunned that of all people the White House picked to pick Warsh was not in my bingo cards. Right? It was completely left, because Warsh historically did not like a vocal Fed. You can't really walk that back at this point in time. Did not favor all this communication. I've been very critical of the Fed over communicating and moving the markets, frankly. And he didn't like a lot of the things that Jerome Powell and a lot of everybody else were doing, because he thought they moved too fast. So he's more of a reactive guy than anybody else. So don't let his age and who chose him fool you. Maybe he's going to listen more to the White House and be more collaborative. Maybe he's not. I don't know. But he wasn't the guy I thought they were going to choose. This article goes on. I'll let you read that on your own. But it's meaningful. Some of the headlines here. The plunging market for private investments might have an unlikely savior, which is, I'm going to say this just because I said on the show and say be done with it, because we believe that tech leads the way in a lot of what the market is, so much so that we actually have tech as part of our market status and then our comparisons. These semi-liquid funds don't lend to the giants of the tech world like the Oracles and Intels. Instead, they parked a lot of their investor cash with mid-sized software companies. How's that working out, software? A debt category that looked like a great risk until late last year, one aspect that may have augmented the funds' difficulties. It's long been common for funds to hold around 10% of their assets in cash, usually a short-term treasuries, to fund redemptions. Okay, but some of these funds are having redemptions of 14%. Some of them are seeing 8%. if you only had 10% liquid, at some point you got to pay yourself back the money. So you're going to do that by not returning funds, investor funds. I mean, this is going to be a negative cycle here. You can see how this ramps up pretty fast. So I'll let that continue on. Read it on your own. It's a great article. The last article here, Deutsche Bank highlights private credit risk as portfolio grows. Again, in the show notes. Frankfurt, March 12th, Reuters, Deutsche Bank here said on Thursday that its private credit fund grew about 6% to nearly 26 billion euros in 2025 as it highlights risks to the headline-grabbing sector. The disclosure made the bank's annual report comes as investors worry about the $2 trillion industry over deteriorating credit quality. Failures of select number of subprime lenders in the U.S. Does that sound familiar? Failures of a select number of subprime lenders in the U.S. increased investor focus on risk associated with private credit and raised wider concerns around underwriting standards and fraud risk, Deutsche Bank said. That is a fucking identical statement to the statements made in synthetic mortgage-backed securities and the underwriting of subprime mortgages in the single-family market that led to the 2008 crisis. If that doesn't scare the hell out of you, I don't know what does. I'm going to read it again just for impact, okay? Failures of a select number of subprime lenders in the U.S. increased investor focus on risks associated with private credit and raised wider concerns around underwriting standards and fraud risk, according to Deutsche Bank. That's nuts. Deutsche Bank said it applies, quote, conservative underwriting standards to its portfolio, which rose from 24.5 billion euros in 2024. Germany's largest lender said it was not exposed to significant risks, but the bank could face potential indirect credit risk through interconnected portfolios and counterparties. Regulators have flagged concerns about banks' exposure to private credit, in part because disclosures are scant. You're in a business with limited disclosures about what's happening. So think about the information trail. Company, private equity, bank. Okay. High disclosure, medium disclosure, low disclosure company. Low disclosure company reports to a medium disclosure company. Medium company disclosure reports to a high disclosure company. Yeah, they've all got audits and accountants and all that stuff, but because of the lack of public information, if you're saying this bank has to carry more risk because the underlying default rate possibility of these companies in these private equity funds, but you have a low disclosure set of information coming from these companies, which are generally not public companies, how do you assess the risk at this bank level? Well, you don't. You struggle, right? So it's a very challenging zeitgeist. All right, that has been an hour-long show. I've gone on and on, been a whole bunch of energy. Let's see where the market is to end the show because the status was changing. We are still in a growth run, healthy bull market, up from a tech-led rally when we started the show. Synthetic volatility index still sitting at 81. And yeah, that is a crazy, crazy pivot midday. I appreciate all of you guys for watching the show. For those of you who do come back and watch it, it means a whole hell of a lot. It means I said something that may have interested you. And that is, frankly, the only reason we do this, right? If you want to support us, you can go to our merch store, thspod.com, buy some merch there. It does help a little bit, although most of that is given away at cost. You are a walking billboard for us, as I am for myself. If you want to support us in a more meaningful way, you can go to Join Friday, schedule a consultation, see if there's anything there that might appeal to you. Use code HIGHER, get $100 off your first order. You can always email us, media@higherstandardpodcast.com. I am one of two hosts. My other host is Saeed Omar. You will hear from him with me tomorrow on Tuesday's drop. The Higher Standard Podcast drops at 7 a.m. Pacific Standard Time tomorrow. And Rosie, thank you for ordering the merch. 3 items you ordered. I got the email the other day, and I was like, "Aw," but it was like 5 a.m. or something whenever I noticed it. So I apologize for not reaching out to you sooner, but it means a whole lot that you support the show, and thank you for doing so. If you have any recommendations for how we improve, we're always open to hear it. We want to hear your thoughts, suggestions, and more. But from the bottom of our hearts to you, we appreciate you. Until next time, everybody. Okay, bye!